Welcome, everyone. We are just so happy to have all of you with us. The Office of Gift Planning and Northeastern School of Law initially sponsored this event intended for the School of Law graduates, but we opened it up to all alumni, and we're just thrilled to get such a great response. As Diana mentioned, it's being recorded. You will be able to see this on YouTube. So you don't have to write feverishly. Of course, you can if you wish. I know I would be, but you'll be getting this again later. I believe Diana told me that she could send it out to you by email. So look in your inbox and check your spam, hopefully sometime tomorrow. We did receive some great questions beforehand too. So thank you to those who submitted them. You can still add questions in the chat, as Diana mentioned, and we will get to them as best we can in the Q&A portion of the program. And now I'm just pleased to introduce our expert speakers, Brad Bedingfield and Nancy Dempsey from Hemingway & Barnes here in Boston. Nancy is a partner at Hemingway & Barnes and serves as a professional trustee and executor and advises clients on estate planning and estate and trust administration. She also represents nonprofits in connection with planned giving and development. Nancy helps clients develop and implement tax-efficient wealth transfer strategies for a variety of complex assets in ways that are consistent with her clients' overall goals and values. She is a trustee emeriti of the Museum of Science, Boston, and Old Sturbridge Village. She currently chairs the board of Manomet Inc., a leader in migratory shorebird research and conservation, and serves on the boards of the Bromley Charitable Trust, Round the Bend Farm in South Dartmouth, and the Don and Marilyn Rodman Foundation. And Brad is also a partner and chair of the nonprofit group at Hemingway & Barnes. Brad works extensively with individual donors, private foundations, and with charitable institutions on complex gifts and planned giving matters. He has over 15 years of private practice with national firms and also previously worked as a tax law specialist with the Exempt Organizations Division of our friends, the IRS in Washington, D.C. He serves on the boards of the American College of Trust and Estate Council and the Planned Giving Group of New England. So no matter where each of us are in our own retirement, estate, and philanthropic planning, I know we'll learn something new and valuable from this discussion. So now I'm just going to turn it over to Brad, who will start off with us. And I think, Brad, you've got your screen up already. Is that right?
I do. Thank you so much, Lori.
You're very welcome.
Thank you. And thank you, everybody, for spending your lunch hour with us. We really appreciate that. It's a lot of fun to be here. So for each of the past several years, as we've moved into the fall, Congress has been gearing up for its fall legislative agenda, which for each of the past several years has involved at least the potential for major tax changes that affect estate planning, retirement planning, and charitable giving. This year, things seem to be relatively calm in that regard. We've got an election year. There doesn't seem to be a considerable appetite for making more big legislative changes in DC. However, already baked into the tax law are some changes that we need to be paying attention to. One of those we call the estate tax cliff, where in 2026, the current federal estate tax exemption amount, which Nancy's going to talk about in a minute, is going to drop in half, which is going to subject a lot more people to the federal estate tax than have had to worry about it for a number of years. In addition, many states, Massachusetts being one of the more onerous, still have state-level estate taxes, which can apply to a lot of people who don't think they need to be thinking about estate taxes, and can come as a big surprise, in particular to people who live outside of the state but have property in the state and find that now they have to wrestle with the Massachusetts estate tax. And even for those who aren't concerned with taxes, they need to be thinking about practical issues for leaving your assets to loved ones and to favored causes in a way that will avoid undue cost and administrative burden. So for today, we'd like to focus first on some practical tips regarding estate planning, which will be useful to you whether or not you're concerned about estate taxes. Secondly, we want to talk about some easy steps that you can take to reduce both the complexity of your estate and the tax burden on your heirs. And finally, we'll discuss a few tax-efficient methods for making charitable gifts. And with that, I'm going to turn it over to Nancy, who's going to walk us through some practical estate planning tips.
Thanks, Brad. So these tips are all the burdens on you, not on your advisors with these, but these are really important. Every one of these, it's not easy to do all of them, but this will really help you have a good estate plan. And the first one is know what you own. That sounds really simple, I understand from Lori that Northeastern has an estate planning workbook that you can download. That'll give you a start in terms of inventorying your assets. Don't worry about it being perfect, but if you have something that you think might be valuable, you should get an appraisal. I had clients who liked a painting that was hanging in their guest room. I encouraged them to get it appraised. They found it was worth $500,000. They had no idea. If you collect something, here's the other one where all of a sudden you don't realize you own 2,000 of something. So even if each something isn't that valuable, when you take it times 2,000, it is valuable. So those are the kinds of things that are really well worth the effort. Second, know what your financial needs are. A lot of estate planning has to do with making some lifetime gifts or giving some part of your estate to charity. You won't know how much you can give away until you know how much you need to keep. So what are your annual expenses? What size savings do you need to really cover your elder care in later years? What might your children need? Once you have those numbers pinned down, then it gets a lot easier to have a strategy around making gifts. The third really important thing is to title your accounts properly. Don't rely on memory. Check your deeds. Do you own something jointly, tenants in common, bank accounts, brokerage accounts? Don't just put your children's names on things as joint owners without thinking it through. If you have 4 children, but you put only one child's name on a joint account, that child's automatically entitled to inherit the asset and the other 3 are cut out. So make sure you're doing those kinds of things with advice. 4, make the right beneficiary designations. So assets like retirement accounts and life insurance aren't really governed by your estate planning documents. They're governed by the beneficiary designations. For IRAs, you're usually going to want to have your spouse, if you're married, as the beneficiary, otherwise children or charity. Usually not your estate as a beneficiary. It has to be cashed out sooner. For life insurance, it's often instinct to name individual beneficiaries, but you might need that cash in your estate to pay estate taxes and funeral bills, so, or in your trust. So you need to have a plan for that. And the other thing that's coming up all the time and actually causing some trouble is transfer on death accounts. You can now designate beneficiaries for brokerage accounts, and the brokerage firms are really, they're trying to be really helpful and avoid probate. They're encouraging people to have a beneficiary for every account, but you have to think that through with your advisor. I've had situations where there was a beneficiary on every asset. It was a larger taxable estate. There was nothing for the executor to use to pay estate taxes with. He actually had to claw back percentages from various family members in order to pay estate taxes. You don't want to put your poor executor in that situation. Another point, planning for payment of estate taxes and debt. So this is important if you have a lot of real estate and not as much in liquid savings. It's easy to estimate what estate taxes might be, what funeral expenses might be. So just make sure there's a way that the cash is going to be available. Estate tax is due 9 months after death. Don't procrastinate. Don't let the perfect be the enemy of the perfectly good. So get a core estate plan in place. Even if you're not sure about certain things, you can always tweak it later. If you don't have an estate plan, the state laws are going to say where your assets go. It may be the opposite of what you actually want to do. Item 7, spend the time up front to make sure your advisors have a complete picture of not only your assets, what is your family like, what are your goals, and are there issues they need to be aware of? A lot of times people hesitate to do an estate plan because they just don't know how they're going to solve for a child who has a substance abuse issue. It's a blended marriage. Your advisors have seen all of these situations before. Just be honest with them. They have a duty of confidentiality. There are solutions. There's a lot of tools in the tool belt that can help with these things, but they can't help you have a good plan if they don't even know the issue exists. Which leads us to 8, be realistic about your family's ability to handle things or get along. This comes up when you're picking executors or trustees or attorneys in fact under your power of attorney. Are there sibling rivalries? Do we have step relatives? Do we have substance abuse, mental illness? All of those things factor in, and you need to be realistic. Your advisor doesn't know what your family's like unless you share that. Hire good advisors and listen to them. There's lots of good advisors out there. That's not hard. Don't try to do an online will yourself, though. That's not going to be a good result for you in general. But listening to your advisors and following through, that's on you, and it's really important. You could have the most beautiful set of written and signed estate planning documents, and if you don't follow through to title your assets the right way and have the right beneficiary designations, you're not going to have a good estate plan. And finally, keep your plan updated. A good estate plan is flexible and can probably last you for many years. But if there's a divorce, an inheritance, the birth of grandchildren, things like that, that's when you want to do a checkup and see if you need to change anything. So this slide just reminds us that when we're looking at strategies, we are going to have sometimes specific strategies depending on the type of asset. And the next slide talks about tax planning strategies. So the federal exemption is really high right now. It's 12.06 million, scheduled to go up to 12.92 next year, scheduled to drop to less than half than that in a couple of years in 2026. Once the federal estate tax hits, it's a flat 40% rate. The gift tax, there is a federal gift tax, but it's that same high exemption. And the other thing to keep in mind under our current estate plan and the one that we'll have in 2026, absent further legislation, you get a full basis step up at death. What is basis and why is that important? Cost basis is what you pay for stock or real estate or capital assets. And you pay capital gains tax on the difference between what your cost basis is and what you sell the asset for. So the fact that you can take a piece of real estate that you might have paid $250,000 for that's now worth $2 million, and your heirs can inherit it and then sell it for $2 million and not pay capital gains tax is very powerful. So you want to keep that in mind as you do your planning. Another thing to keep in mind is, where am I located and where are my assets located? Because there are a few states left. The colored states have estate or inheritance tax. The gray states do not. So you can see that in New England, we're in the minority there. Massachusetts has a really stingy estate exemption of $1 million. There's been legislation to try to raise that, but nothing's happened yet. So you need to be mindful of that. You need to be mindful of that if you live in a state with estate or inheritance tax, or if you own real estate or tangible property like artwork or cars or what have you in a state with a estate tax. So what can you do about estate taxes? Well, one of the things you can do is to make gifts during your lifetime to get the size of your estate down. And there are some benefits to that if you can afford to do it. So one thing is your children probably need the money more now than they will later at the time of your death. And also, if it's done right, it can provide a sense of independence. If there's a separate generation skipping trust that helps pay for college or helps somebody buy that first home, they can go to that as opposed to going to mom and dad when they need help. It's actually builds some independence for the children and helps keep the family relationship, keep the financial side out of the family relationship. One of the most powerful things about lifetime gifts is the fact that those assets are growing outside of your taxable estate rather than inside. If you put $1 million into a generation skipping trust when you're younger and you let that grow for 30 years at 6%, you'll have 5.7 million in that trust. So there's a real power to that if you can afford to give something away while you're younger rather than waiting till death. For really large estates, there's an advantage to lifetime gifts because you don't have to pay gift tax on the dollars that go out to pay the gift tax. With the estate tax, the dollars that end up going to pay estate tax are actually subject to tax as well, which is hard. And then you can gift assets during lifetime to avoid estate taxes if your state has a state estate tax. So I like to talk about no-brainer stuff, low-hanging fruit. So some of the common types of gifting that make a lot of sense are the annual exclusion gift. You may have heard of that. You can give $16,000 per person per year, $17,000 per person next year, and you don't have to file a gift tax return or worry about it. You can front load a 529 plan for grandchildren with 5 years worth of gifts. And another biggie that we don't often think about is you can directly pay medical expenses or tuition. I mean, I have a family where we track these gifts and they've given away over $2 million this way. So you write the check to the institution. If it's for tuition, you write the check directly to the orthodontist or the eye doctor, whoever it is. If it's for a medical bill, you can't reimburse your family for those expenses. If you plan to do this and you want to make it easy, one thing you could do is take out some duplicate credit cards in your name, you get the bill, and tell your children or grandchildren that if they have an orthodontist bill or a prescription to fill or whatever, what have you, they could put that on that credit card, and then it's as if you've directly paid it. Another kind of no-brainer for gifting during your lifetime is life insurance, and that you're not going to really tap into that usually during your lifetime. You could get it out of your estate by simply giving the policy ownership over to your spouse or your children, or you could transfer it to a trust. And as long as you don't own the policy and you don't control who the beneficiaries are, it's out of your estate. Is there anything critical to think about now? If you're really wealthy and you're over that federal exemption, you want to use up the high exemption amount before it sunsets in 2026. All right, so then are there other gift strategies to think about? There are ways to really squeeze out the most that you can with your available gift exemption. Most of the things on this list are for wealthier families, and we don't have time to drill down into those right now. But one thing that's used pretty commonly is just making a loan. You could loan money to your children for their mortgage instead of them having to go to a bank. For the rates for these intra-family loans are set every month. For a 9-year term loan, the rate in October is 3.28%. That's certainly lower than what they could find on a commercial basis. So, and then as far as state strategies, we're going to go into an example for Massachusetts. So I'm just going to skip to the next slide. I like this illustration because it's such a common situation. Until we add everything up, we don't realize we have a $5 million estate. But in this case, between the life insurance and the equity in the house and the retirement, sizable retirement account, they have a $5 million estate. Their goal is to leave $250,000 to charity and the balance to their children. And this compares what happens if they don't do any estate planning with what happens if they do some simple planning. If they don't do any estate planning, they're looking at a $365,000 mass estate tax bill on that $5 million estate. And they're looking at about $700,000 of income tax on that $2 million IRA. As the beneficiaries take the withdrawals from the IRA, they're going to pay income tax on it. So with some simple planning, which would involve getting that $1.5 million life insurance policy out of their estate, either make somebody else the owner or put it in a trust, that's going to bring the mass estate tax way down to $200,000. And then use the retirement assets, use $250,000 of that retirement account to fund the charitable gift as opposed to cash from the estate. That saves $80,000 in income taxes. So the total immediate tax bill goes from over $1 million down to $200,000 with some simple planning. And with that, I'm turning it over to Brad.
Great. Thank you, Nancy. So as Nancy was showing in that illustration, when we're thinking about what we're leaving to our heirs, we need to be thinking about the estate tax, but we also need to be thinking about the income tax burden, and retirement assets are where that really comes to the forefront. With other kinds of assets, as Nancy mentioned, you'll get a step up in cost basis, so they won't have to worry about capital gains generally. But with retirement assets, whatever they get out of these plans is going to be subject to income tax as soon as the assets come out. And the beauty of retirement assets, of course, IRAs and 401ks, setting aside Roth IRAs for the moment, are the tax deferral benefits that come with these. We put in money from our paychecks pre-tax, and it grows inside the retirement plan without being subject to tax until it comes out many, many years later on the other end. And the key benefit for that is that we're starting with a higher base for that growth. It's not reduced by the taxes that we would have paid. So all of that is going in and starting to compound immediately. And the difference can be quite dramatic. And there are rules to keep you from deferring too long. Those are the required minimum distribution rules that starting at age 72, you have to start taking that out in the form of the required distributions, and whatever comes out is going to be treated as income to you and taxed as income. So what happens to all of that when you die? Up until a few years ago, it was generally possible for most heirs of retirement accounts to continue that deferral, or at least spreading out the income tax burden over many years, possibly over their lifetimes. With spouses, you could then, and you still can now, roll those plans over into the spouse's plan, which allows you to continue that deferral to a great extent. But if you're leaving the retirement plan to, say, a child, that child, pre the Secure Act, which was passed a few years ago, you could stretch it out over the child's lifetime in certain circumstances. Congress decided that was too much tax deferral benefit. We need to start collecting those taxes sooner. And so they changed these rules so that in most cases, with the exception for spouses and some exceptions for children who are minors and for those who are disabled or chronically ill, in most other cases, when you're leaving it to an adult child, say, that child now has to take the assets out of the IRA, meaning they will be subject to income tax and pay that tax burden within 10 years. In some cases, the payments will have to start right away, depending on how old the decedent was. In some cases, you could wait 10 years, but by the end of that 10-year period, you've got to take it all out. So now that's in the reasonably near horizon. That's a big income tax hit that your kids are going to have to realize that pre-Secure Act was stretched out over many, many years. One other consideration with retirement assets is whether the kids are ready for this much in assets. They're required to take certain minimum distributions, but they're also, if you just name the child directly, which in some cases may be perfectly appropriate, they have the power to pull all of the assets out of that retirement plan. And you may or may not want that for various reasons. Your child may not be ready to control that sort of wealth. They may be in the middle of a divorce or something like that. And so typically in the past, we would often set up trusts to own these interests. And the trust would be set up so that the minimum distribution would pass through to the child, but otherwise the trustee would control how much comes in and out. Those rules are changed as well, so that again, you can't stretch that out over the child's lifetime. Within 10 years, it all has to come out. If you set up the trust correctly, it can come into the trust and not to the child. And so there's still benefits to using trusts, but the trusts have to be drafted very, very carefully to avoid a tighter 5-year rule instead of the 10-year rule. So the bottom line here is that the taxes are going to hit your children sooner than they would have in the pre-Secure Act world, which makes it all the more important to think about other things that you can do with these assets. As Nancy mentioned in her example, if you want to leave some assets to charity, we want to think about our tax-heavy assets, the assets that are going to be reduced by tax and reduce what our heirs are going to get. The retirement plan assets are usually some of the tax-heaviest assets you have. So prioritize using those in your estate plan to benefit charity, to minimize the impact of that tax burden. So we're going to talk a bit more about charitable planning with retirement assets in a minute, but first, a few key estate planning takeaways just to summarize what we've just heard from Nancy. First off, if your lifestyle allows it, if you're in a position where you can afford it, and you want to reduce your eventual estate tax burden, start making some lifetime gifts. Think about those no-brainers first, the annual exclusion gifts, direct payments of tuition and medical bills. Think also about your cost basis. For many people, cost basis planning is going to be more important than estate taxes. If you are making gifts, give cash or give higher cost basis assets. So you're holding on to the lower basis assets. So if you die holding those assets, you get a step up in cost basis and avoid the capital gain. If you have insurance, many people don't realize, many people think I have an insurance policy that's tax-free, right? From an income tax perspective, yes. But from an estate tax perspective, no. If you're the owner of the policy, even if you name other people as the recipients, those assets are included in your taxable estate. But there's simple things you can do to move that out of your taxable estate in advance by naming a trust or some other family member as the owner, not just the beneficiary of that policy. And finally, think about disclaimer planning. When you're talking to your estate advisors, that's one flexible tool to allow your heirs to decide how much might go to charity if you need some flexibility and still get an estate tax deduction. So with that, let's talk a little bit about charitable giving. And I'm going to start with some basic rules just so that we set the framework for some of the strategies we're going to talk about later. So when you make a charitable gift, you get an income tax deduction. That income tax deduction is an itemized deduction. So if you're itemizing your deductions on your return, you can take that. If instead you're taking the standard deduction because you don't have enough itemized deductions, then the charitable income tax deduction doesn't benefit you. For the last 2 years, under the COVID relief bills that Congress passed, there was the ability to take a certain amount of deduction, income tax charitable deduction, even if you were taking the standard deduction, but that's no longer the case. Those have expired. Generally speaking, let's look at this chart for a minute. There's a lot happening on this chart. And so I want to ignore the right side and just focus on the column that says public charity here. And the two things I want to highlight here are, one, how much of the deduction, what's the value of the deduction that you can take? And two, how much of that deduction can you take in the year of the gift, as opposed to taking it in future years? On the right side of that public charity column, that describes the value of the deduction you can take. If it's cash, you can take a deduction of 100% of that cash. If it's something other than cash, like stock or private company interests or real estate, then you can generally take a deduction for the entire fair market value of that property, as long as that property has been held by you for at least a year, long-term capital gain property. If you've held the property for a shorter period of time and you make the gift to charity, your deduction is going to be limited to cost basis. So that's one rule to think about if you're making non-cash gifts to charities. How long have I held this property? Have I held it for at least a year? If so, I'm going to be much better off using that property to give to charity. So that's on the right-hand side. Generally, you can get a full fair market value deduction. If you're giving gifts of tangible property, artwork and things, the rules are much more complicated. Make sure to talk to your tax advisors before you do that. The left side of this column talks about how much of that deduction, that fair market value deduction, can I take this year? And that's a function of your adjusted gross income. If your adjusted gross income on your taxes and your Form 1040 is $100,000, then you can take a maximum of up to $60,000, 60% of your adjusted gross income for cash gifts to public charities. If you're giving something other than cash, then that gets reduced down to 30% of your adjusted gross income. And that can be important where you're making large charitable gifts in a particular year. You want to pay attention to your adjusted gross income and how much you're going to be able to take in that year. Now, if you give more than you can take in a year, you're not going to lose that deduction. It's going to be rolled forward into future years. So if I have $100,000 adjusted gross income and I want to make a $70,000 impactful gift, I can take $60,000 of that right now if it's all cash, and then the other $10,000 I can take in one of 5 future years. But it's something that you definitely want to pay attention to if you're making a large charitable gift. So we've talked about how much you can take at the year of the gift. Now let's talk about what kind of assets we should be thinking about using for charitable gifts. As I mentioned, we tend to use tax-heavy assets. One of the tax-heaviest are our IRAs, and Nancy's going to walk through some considerations and some strategies for using your IRAs to make these charitable gifts.
Thanks, Brad. You always let me do the fun stuff. I wanted to, the comment came in through chat about we should make sure that we're discussing not only traditional nuclear families, but planning for people who choose their family. And I couldn't agree more. In fact, I think planning is really important in that circumstance because you don't have some of the benefits of tax laws are skewed to benefit married couples. And there really aren't any tax benefits that impact children per se on inheritance. But, and I just trying to zip through the slides, I'm using family. My intention is to use family very generically. It could be your created family or your actual nuclear family there. But so I'm sorry, I should have led off with that explanation. But just switching back to one great way to fund charitable giving is to do it from your IRA. You have to be at least 70 and a half or older to do that, even if it's an inherited IRA. You have to give to a public charity, and you can do up to 100,000 a year. And you can't receive benefits in return. So you can't use your IRA to buy a table at your favorite charitable gala. But there are great benefits of using your IRA to fund your charitable giving. You don't have any income tax on that amount. And that's powerful in a state like Massachusetts because we don't get a state charitable deduction, but you would pay the 5% mass income tax if you took the withdrawal to yourself rather than giving to charity. It satisfies your required minimum distributions. And if you're trying to make a bigger gift to charity and you're bumping up against your income, your deduction limits for the year, it won't affect that. If you decide to leave some or all of your IRA account to charity at death, you'll receive an estate tax charitable deduction and there won't be any income tax on that IRA asset. But you do want to work with an advisor if you're going to name a trust. There's some tricky rules that you have to satisfy. Another great way to fund charitable gifts is by giving assets that have unrealized, what we call unrealized capital gains in them. They've gone up a lot in value and you don't want to have to pay the capital gains taxes on them. So a simple example, let's say you want to make $100,000 gift. You could sell stock and give the cash, but you'd have to pay $10,000 in capital gains taxes to do that. Or you could just give the stock directly to the charity. The charity can sell it, not pay any income tax, and you get that full $100,000 charitable deduction. And then Brad did this example, which I think is great because people are wondering, should I use cash to fund my charitable gift? Should I use an IRA if I'm over 70 and a half? Or should I use appreciated stock? And in this assumption where they wanted to give $100,000 to establish a scholarship fund, and they had appreciated stock or cash, and they had income of around 300,000, the best result was to do the appreciated stock gift. So that saved them 42,500 of taxes. The next best was to do the IRA distribution to charity. And then the third best was to do the cash gift. So it certainly pays to crunch some numbers and figure out the most strategic way to fund your charitable gift. Some other things that you can do, we don't have time to go into these in detail, but charitable remainder trusts work well. If you have an appreciated asset, you want to sell it, diversify the investments, and defer capital gains taxes. Charitable lead trusts work really well. People don't use them enough. They're for wealthier taxpayers who want to really leverage the amount they get to beneficiaries, but also fund current giving to charity for several years. You can do a simple but large gift to charity if you had a vacation home and you don't want to leave it to any individuals. You could retain the lifetime right to use it in a deed. And the deed could also give the remainder to charity. And that leaves a big gift to charity after you're gone. It's a very simple but very effective thing that you can do. Or you can do a bargain sale or a charitable gift annuity. And the bargain sale, let's say there's land, you need to get some money for it, but you don't have to get top dollar. You could sell it to charity and you get a tax deduction for the bargain piece of your gift, plus you get the cash.
Great.
With that, it's back to Brad.
Great. Thanks, Nancy. So we were talking earlier about retirement assets and the fact that after the Secure Act from a few years ago, Congress said, no, you can no longer extend the tax deferral for for leaving it for someone other than a spouse or minor or disabled individual, say a child or some other loved one, over that person's lifetime. Instead, you've got to take it all out within a 10-year period and pay the tax on that. But there is one way to effectively get something similar to what you were able to do before, where you were comfortable leaving a portion of this to charity as well. So if you're interested in leaving a legacy to charity, but you want to provide that sort of annual payment to a child or some other loved one that you previously could have done just directly by naming them and spread the tax benefits out, one way to do that is to match up an IRA with a charitable remainder trust. Nancy mentioned charitable remainder trusts a minute ago. Just to give a little bit more information about what these are, charitable remainder trust is a trust where you put some assets in, you or a loved one, say a child, will receive for that child's lifetime an annual payment. That annual payment can be a fixed dollar amount, or more commonly, because of the way that the tax benefits work, a percentage interest, say 5% every year. So you put assets in, your child gets 5% of the assets every year as a regular payment until the child dies. And then when the child dies, everything goes out to charity. And it's possible to have more than just one beneficiary. You can have successive beneficiaries, but there's a point where mathematically you have to cut it off and make sure that the charitable remainder has a certain mathematical value. But if you do that, then you're creating a lifetime income stream for a child, but you've got this impactful benefit to charity at the end of that. And we've often used these historically for highly appreciated property, where you take a highly appreciated property that if I were to sell it, I'd pay a big capital gain tax. Instead, I put it into a charitable remainder trust. Charitable remainder trusts are exempt from tax, so they don't have to pay that tax. So they sell it, they don't pay any tax. But that tax is remembered in the trust. And as the distributions come out to, say, your child, then those distributions carry some of that tax out with it. But if the distribution's 5% a year, then it takes a while for all that tax to come out. And so it gives you some deferral of that tax. And now we're investing on, as with IRAs, you're investing on a higher starting point because it's not reduced by that tax. Well, the same thing works with IRAs. If we can't stretch the IRA out past 10 years, okay, we won't stretch it out at all. We're just going to dump it right into a charitable remainder trust. The charitable remainder trust is subject to that income, but it's exempt from income, so it doesn't have to pay anything now. But the trust remembers that income, and as the 5% distributions come out to your child, those will be taxed as ordinary income that was attributable to the IRA for as long as those payments continue until all that tax and any future tax on any future growth is paid. So it gives you the ability to, again, start investing with a much larger base and build those investments over time. It also gives you some creditor protection benefits where you might not be comfortable leaving the IRA directly to a child. If instead you give them a 5% payout from it every year, that's all they get. So their creditors, divorcing spouses, et cetera, can't get a hold of the corpus itself, just the assets that actually come out to them. And you get a partial estate tax deduction in your estate, because the portion that's going to charity at the end of the beneficiary's life has a value and an actuarial value, and you get an estate tax deduction for that value. One consideration with these is that when the child or the other beneficiary that you name dies, all the assets are going to charity at that point. So it's generally not something for multi-generational planning. But if you're looking to set up a regular income stream for children to defer that income tax burden and allow it to spread out in the way that we used to be able to do with IRAs, and then still have something impactful for a charitable legacy, at the end, this can make a lot of sense, and it's definitely something worth considering. One other thing, so we're talking about what kinds of assets to use to give to charity. We like to give tax-heavy assets, so that's IRAs, that's appreciated assets. We also like to think about assets that don't affect our daily cash flow as much. And this is a slide illustrating some of those. Real estate is a good example for that. You can have real estate that's very valuable that can make for an impactful charitable gift, but giving it away may not affect your daily cash flow depending on how you're using it. Life insurance can be an effective charitable gift. Privately held interests are often used for charitable gifts. Cryptocurrency is one that we're seeing more and more commonly now. 10 or 15 years ago, it was the subject of speculative articles, but nowadays almost everybody who works in this field has dealt with cryptocurrency gifts one way or another, and more institutions are equipped to accept these kinds of gifts. And those can be very, very impactful. Even with cryptocurrency values being a lot less than they were a year ago, there's still a lot of people who are holding a significant amount of cryptocurrency that can make those kinds of gifts, but not affect what they need on a daily basis. And finally, a couple of other alternatives for philanthropy other than just direct gifts to charities. Many people these days are setting up donor advised funds. Those are funds that are housed in public charities. So for the most part, the gifts that you make are subject to the same tax benefits as gifts to public charities, with a few exceptions. Those qualified charitable distributions from IRAs that Nancy mentioned don't work if it's to a donor advised fund. But otherwise, direct gifts do give you those same sorts of tax benefits. And then you have advisory privileges with respect to those funds. And you often, there's a portal, and you go online in the portal and you recommend a grant here and a grant there. More and more, many of you are familiar with the more large national donor advised fund plans, but more and more charitable institutions have set up their own donor advised fund programs. Often these are integrated with the work that those charities are doing. And in many cases, when you set up a donor advised fund at an institution like that, you're advising a portion of it to be used in different ways at the institution, a portion of it that could go to other places if you have other philanthropic interests, or could go to the institution as well. So consider that, and those can be particularly powerful if you know you want to make a charitable gift for tax purposes or for other purposes, but you're not quite sure yet exactly how you want it to be used. So you make it, it's a completed gift, you get the tax benefits, but now you've got some time to figure out how you want it to be deployed. And some people still set up, and we do this quite regularly, private foundations, where you're actually setting up a new entity and controlling it. Generally, because that's a new entity with a lot of compliance obligations, we tend not to see that, except for people who are devoting a certain amount of wealth to it. But it's still a common solution. So a few key takeaways, and then we're going to move into the Q&A session. Think about your tax-heavy assets. To the extent that you want to make a gift to charity, identify those assets and prioritize those. That's generally going to be your retirement assets or appreciated assets that have a lot of capital gain that you weren't planning to hold on to until you die. And so eventually someone's going to have to pay that cap gain. If you give it to charity, the cap gain is avoided. Think about if your circumstances make this make sense. Think about leaving your IRAs to charitable remainder trusts so that you can spread out the tax impact over time and allow those assets to be invested earlier on without that negative tax impact. And think about assets that you may have. Nancy refers to these as assets in the couch cushions, things that you have that are there, but they're not part of your daily life necessarily, and therefore can be both impactful, but not affect you negatively on a daily basis. And that's it. And with that, let's move to questions.
Okay, great. Thanks, Brad and Nancy. A lot of information here. I think we have a few questions. I think there's right here. And do we need, oh, here's a good one. Do we need to keep any records of our annual exclusion gifts?
Yeah, I can take that. That's a great question. If you're just doing a straight cash gift, annual exclusion gift, you really don't need to keep a record of it. If you were giving something that didn't have a ready market value, like interest in a closely held business or, a tangible item, then you were, then you might want to keep records on that, because if you haven't reported the gift on a gift tax return, the IRS could come back and look at any lifetime gifts, including exclusion gifts, and they could say that you undervalued the gift when you made it, and more taxes due. If you're giving something like that, the best practice would be to get it appraised and disclose it on a gift tax return, even if it is only 16,000, and get the statute of limitations running. If you fully disclose a gift and you file a gift tax return, the IRS has to audit that within 3 years. Otherwise, absent fraud or something, you are protected.
Okay.
And it's worth noting, just to supplement that, if all you're making is annual exclusion gifts in a given year, you don't have to file a gift tax return.
Right.
But if you make more gifts than either the annual exclusion gifts or the ones that Nancy mentioned, where you're directly paying schools and hospitals and things, those you don't have to report unless you make larger gifts. If you make larger gifts that require you to file a gift tax return, then you've got to report all your gifts, including those annual exclusion gifts. So in particular, if there's a year where you're making bigger gifts, then you want to keep good records, because you're going to have to report that on a tax return.
Okay, here's another one. Can you describe the advantages or disadvantages of converting a traditional IRA or a 401k to a Roth?
Well, we could do a whole webinar just on this, but just briefly, as I mentioned with IRAs, the beauty of those is that you're putting tax-free dollars in, you're investing with a larger base now because you haven't paid tax yet. So that's there to invest. And over time, if you start with a larger base, it's going to compound faster. And so the theory is, as long as markets are going up over the long-term horizon of a retirement account, then not paying those taxes at the front end, but paying them at the back end is generally gonna pay off. When you set up a Roth or you convert to a Roth, you're doing the opposite of that, which is not necessarily a bad thing. So you're paying some tax now, either because you contributed to a Roth or because you converted to a Roth, and now you've got to pay income tax on the converted assets. But now it grows inside the Roth, and when it comes out, you don't have to worry about taxes on that side. That may be a good deal, or it may not be a good deal, depending on how the investments are going to go and how long your time horizon is. So you're paying the taxes, and that reduces now the assets that you have available to invest. But if you invest for long enough and the investments go well enough, you could catch up to that initial sort of reduction and even surpass it over time, with the benefit that when it comes out, it's not going to be reduced by taxes there. So a lot depends on your time horizon. If you've got a long time horizon, then you may well be better off converting to a Roth, but you want to do that math and that calculation in conjunction with your tax accountants and in conjunction with your investment advisors, because there are a lot of assumptions that will feed into that calculation, and the right answer for one person may not be the same for another.
Okay, here's a good one. It might take you a while. What is probate, and is it expensive?
So probate is proving the will in the probate court. So it's a process of getting the will officially approved by the court as your last will, and getting executors officially appointed or personal representatives. And each state has its own rules regarding probate. And there's definitely, because a lot of states have modernized their probate code, including Massachusetts. In a state with a modernized probate code, the process there's a lot more options now, and it's much more streamlined than when I first started practicing. And in Massachusetts, we don't have high probate fees that get paid to the court, because real estate isn't part of how the probate fees calculated. You do have the cost. If you do a formal probate in Mass, you have the cost of publishing in the newspaper, the notice, and you have some time delay in terms of waiting. There's usually at least a 6 to 8 week notice period before the will can be formally allowed by the court. And then it takes them a bit of, a few more weeks to issue what are called letters testamentary, which are it's the official document that says, yes, you are the personal representative of the estate. That's a document you can use to close a bank account, brokerage account, do things on behalf of the estate. So we always end up doing a probate in Massachusetts, because even if somebody thinks they have everything out of their probate estate, it's all in trust or goes to beneficiaries that are named, there's usually a refund or a tax return that needs to be signed. There's something that needs to be done on behalf of the estate. And banks are pretty picky nowadays. If there's a check that comes in the decedent's name or in the estate's name, it's getting very hard to deposit that check without proof that you have a executor or personal rep in place. So that's my answer on probate.
Yeah, one thing to supplement that, we wherever the decedent has died, there's going to be a primary probate, but there's also going to be ancillary probate in states where the decedent had other assets. And this is where trying to take steps to limit that probate can make your life or your heir's life a whole lot easier. If you've got a place in Florida and a place in California, those are going to require some court proceedings in those places, and that can be more or less onerous depending on the state. And sometimes there are steps that you can take, like for people who have moved out of Massachusetts but still have a vacation home here, there are sometimes steps you can take to take that out of what will be a probate estate and simplify the work that's going to have to be done when you die.
Yeah, I mean, that's why not everybody needs a living trust or a revocable trust, but if you have one, then you can put the assets that are out of state, just title them in your living trust. And that's all you need to do to avoid probate in that other state. So it's pretty simple. You still have control over the asset. Brad, there's a question about, since you covered IRA planning, there's a SEP IRA. Someone's asking, they have a self-funded IRA or a SEP IRA. Is there anything different about planning for that kind of IRA versus other IRAs?
Not really in the context of what we're talking about. SEP IRAs similarly have required minimum distributions, similarly are subject to the 10-year cutoff. So again, like with other IRAs, if you've got charitable intentions, that's a good source to use for making those distributions. Some of the some other kinds of retirement assets like 401ks and things, you may need to convert to IRAs to be able to do some of the stuff we've been talking about, like making qualified charitable distributions during lifetime as opposed to leaving assets on death. But that's something that you can do depending on the nature of what kind of retirement plan you have.
And can they do, the other question they had is, can they do a spousal rollover? Should the spouse be the primary beneficiary, all things being equal?
Yeah, that's usually the default, unless there's some reason why not, like you've got kids from a different marriage and you need some of those assets, but generally speaking, in most cases, assuming that you want your spouse to have, most or all of your assets, and then everything else happens when both of you are gone, the simplest answer is usually just to name your spouse directly and let the spouse roll it over into their own. That maximizes the flexibility for deferring tax, and then they can, from their retirement plan, do all the stuff we've been talking about.
Lori, do you want me to take, there's another question.
Yes, please do.
So this asks, what about crummy trusts? A crummy trust is named after the case that said that you could make a gift to a trust and still have it qualify for that $16,000 per person annual exclusion. And yes, crummy trusts are still very valuable for estate planning. I don't like the name crummy, so I like to call them annual gift trusts or what have you. But so let's say you want to start piling up some funds for a young beneficiary. You can do the $16,000 a year into the trust, and then you can decide at what age the beneficiary should have access. If you put $16,000 in a year and it keeps growing, there's going to be, there could be $1 million in there at some point. So you wouldn't necessarily want to let the beneficiary pull everything out when they turn 21, which is what happens with a minor's account. So with a crummy trust, you can pick whatever age, let them take some out when they turn 30 and some out when they're 35. So they're a very common vehicle for just putting annual gifts into. They're also, most life insurance trusts are set up as crummy trusts so that when you pay the premiums every year, it qualifies for the annual gift exclusion and you're not using up your lifetime gift exemption.
Okay, and here's another one that's interesting. Why can't I simply give my daughter all her inheritance now while I'm alive and not tell anyone?
Brad, you want to take that?
Sure. With respect to your assets, you can give whatever you like. And as Nancy said in one of her practical tips, make sure you know what you need, first of all. Don't give away more than you can comfortably give away. You're going to need more than you think you're going to need for later in life care and various other things. So, if you make a gift of everything to a child, say, and now you need some of it back, that child is going to have to make a gift back to you. And that's not a very efficient thing because that's also a potentially taxable gift. So first off, make sure that you don't give more than you can comfortably give away. If you do, we've recommended making gifts now during lifetime to reduce estate tax, both federal and state estate tax. But the not tell anyone piece is problematic if by anyone you mean the IRS. So if you are making a gift that's in excess of that annual exclusion amount, or the direct gifts for paying medical and educational expenses, then you have to report that to the IRS. And if you don't report that to the IRS, then when you pass away, your executor is going to have to clean up all that mess, because when they file an estate tax return, they're going to have to show all the lifetime gifts and what you filed and what you didn't file. And so if you just make the gifts and you don't tell anybody, you don't report to the IRS, you're creating a mess for your heirs down the road to have to clean up, with possible very negative tax implications as well in terms of penalties and things.
And I think we have time for one more. And I think you touched on this anyway in your slides, but let's just put it out here. What are the pros and cons of using a donor advised fund as opposed to making direct gifts to charity?
Sure. That's increasingly common. I often see that, as I mentioned, where somebody knows they want to make a charitable gift, but they don't know exactly how they want it to be deployed yet. At the end of the year, you've got you own shares in a company that's about to sell, or you own real estate that you're planning to sell, and you want to give some or all of it before sufficiently before the sale, so that you don't realize that income, but you haven't yet decided what you want your impact from that to be. DAFs are a wonderful choice for that, because you put it in there, but then you still have that advisory relationship and that input on how the assets are going to be used. For certain kinds of things, it may not work for qualified charitable distributions, for example, but for direct gifts, it works very well.
And I would be remiss if I didn't remind everyone that Northeastern also has a donor advised fund, and you can have more information on that on another session, perhaps. But I think we've covered an awful lot, as much as we possibly could in an hour. As a reminder, you'll be receiving a recording of this presentation together with a link to Northeastern's estate planning toolkit. And we encourage you to download it, share it with your family and friends. It's a great tool. And I just want to thank you both again for sharing your thoughtful insights and your expertise. And thank you to all our Huskies for joining us this afternoon. Enjoy the rest of your day. Thanks again.